So, you've built this amazing business from the ground up. It's profitable, it's growing, and now you're starting to dream about that big exit, right? But what if the one thing that could completely derail that dream isn't a market crash or some new competitor, but a tiny detail hidden deep inside your own books? So, let's dive in and break down how one tiny detail can change, well, everything. Right, so you're at the top of your game. The business is firing on all cylinders. And you might be thinking, hey, I'm perfectly positioned for a huge sale. But are you truly ready for the kind of scrutiny that comes with it? Okay, and this is where it gets really serious. I mean, we're not talking about small mistakes here. We're talking about these fundamental differences in accounting that can make a buyer slam on the brakes, slosh the value of your company, or just walk away completely, literally leaving millions of dollars on the table. And that right there leads us to this huge blind spot that so many successful founders have. It's a hidden flaw that comes from being so focused on the day-to-day wins of the business without ever really thinking about the day you might want to sell it. To really get our heads around this, we need a framework. And in the world of exit planning, the gold standard is this concept called the three-legged stool. It sounds simple, but it's incredibly powerful for making sure a transition goes smoothly. The whole idea here is that for a stable exit, all three of these legs have to be in perfect alignment. You need your business goals, your personal goals for what life looks like after the sale, and, this is the big one, rock-solid financial goals. If any one of those legs is wobbly, guess what? The whole thing comes crashing down. And it's that financial leg, that foundation, that we are really going to zoom in on today. I love this quote because it just nails the point. Sean Kennedy, who's a certified exit planning advisor, puts it perfectly. You can have the most beautiful business out there, the brand new kitchen, the perfect landscaping, but if that financial foundation is cracked, buyers are going to run the other way. Look, for years, you've probably looked at your accounting department, your bookkeeping, as just another cost, a necessary evil, right? But when you go to sell, that whole perspective has to flip on its head. The cost of not having clean, buyer-ready financials is just astronomically higher than what you'd invest to get them right in the first place. Okay, let's make this real. Let's look at a real-world story to see exactly how this plays out. This is a case study of an amazing company that had a deal ready to go, only to watch it come to a screeching halt. So picture this. You've got a company in a really hot industry, and it's seeing this impressive steady growth year after year. I mean, this company had it all. Great operations, solid management team, and a buyer has already signed a letter of intent. On paper, everything looked absolutely perfect. And then, the moment of truth arrives. The seller hands over their financial statements. The buyer takes one look and just slams on the brakes. The entire deal is put on hold. And it wasn't because the business was bad. It was because the numbers, well, they just didn't make sense. There was no clarity, no comfort. And this is the absolute core of the problem, right here. See, the buyer needed to see books prepared under what's called GAAP, generally accepted accounting principles. They needed that accrual basis view to see the real health of the company. But what they got was a set of books designed to do one thing and one thing only: minimize the owner's taxes. Which is great when you're filing your taxes, right? But for a potential buyer, it's a massive red flag. So the deal's stalled, value is just leaking out of this thing every single day, and the owner's totally stuck. So they bring in a team of experts to do one thing: dig into those books and find the truth. And what they found, well, it wasn't a fatal flaw, it was basically buried treasure. So this team gets to work like immediately. They told the owner, listen, we are going to look under every single rock. Their first move, go after the expenses. Because in a tax-focused world, you expense every little thing you possibly can. But under GAAP, a lot of those things should actually be capitalized, which completely changes the picture of how profitable the company actually is. And bam! Here's what they found. By just reclassifying expenses the right way, according to GAAP, they found $250,000 in legitimate addbacks to the company's earnings. And since the sales price is based on a multiple of those earnings, that one change, just an accounting change, directly pumped up the final sales price. Incredible. But wait, it gets better. They weren't done yet. I mean, with just 48 hours to go before this deal was supposed to close, they made another huge discovery. In this next one, it was literally sitting there in plain sight. So it turns out this company, being in the service business, had all this inventory on its service trucks that was just never being tracked on the books. They did a full count and found $400,000 worth of parts just sitting there. Because of how the deal was structured, that money went directly into the seller's pocket as a quote-unquote bonus at closing, a huge win that was almost completely missed. And this, right here, is maybe the most important takeaway of all. Sean Kennedy points out, listen, we didn't do anything to improve the business operations. We didn't add new systems, we didn't inject capital. All of this value, we're talking hundreds of thousands of dollars, was just unlocked by applying the right accounting principles. So, how did they actually pull this off? How did they save the deal? It wasn't by being aggressive or hiding things. It was by completely changing the whole vibe of the deal. The team laid all their cards on the table, total transparency with the buyer, explaining every single adjustment they were making. They kept the communication lines wide open with all the lawyers involved, and critically, this freed up the owner to do what he does best, keep running his great business, which, by the way, is exactly what a buyer wants to see. You see, this just completely flips the script on how you should think about selling your business. It's not this big us versus them fight. When you have clear, accurate financials as your foundation, the goal changes. It becomes about getting a fair deal across the finish line, where everybody walks away happy. And that, of course, brings us right back to you and your business. As you're building your company, really think about the foundation you're laying. Are you building a financial house that looks amazing from the street, but is actually ready to crack the second someone applies a little pressure? Or are you building a foundation that's solid enough to actually secure your future?